All right, let's unpack a real puzzle we saw in the markets on December 23rd, 2025. We just witnessed a huge rally, but the reason it happened might actually be the biggest warning sign for what's to come. This is the story of what some are calling the disinflationary boom. So, on the surface, everything looks fantastic. But what if the thing that looks like the best news is actually a huge warning sign in disguise? That's the big paradox we're digging into today. How can an economy that's this strong possibly be its own worst enemy? I mean, the markets were just flying high. The tech-heavy Nasdaq had a really great day, but the real showstopper, the S&P 500, which just blasted through to a new all-time high. Wow. So you'd think it was just a day of pure optimism, right? But what was really behind all this? So what was the rocket fuel for this powerful rally? Well, it all comes down to one just staggering piece of economic news that frankly blew everyone away. Yep, that's the number, 4.3%. That was the US GDP growth for the third quarter. Just blistering. And look, this wasn't just a little better than expected, it smashed expectations. We haven't seen growth like this in 2 full years. And you know, what's really interesting is that this boom isn't just about one thing. It's this powerful mix of everything working at once. You've got consumers out there spending like crazy, which basically just erased any lingering recession fears. Then you have these massive innovations happening, from pharma to AI. And on top of all that, people are buying up hard assets like copper and gold. I mean, the engine is firing on all cylinders. Okay, but here's the twist, and it's a big one. All of this amazing economic news, it's actually creating a massive headache for the one institution that everyone has their eyes on, and that's the Federal Reserve. And this, right here, gets to the absolute heart of the problem. You see, everything that looks great for the economy on the left makes the Fed's job on the right so much harder. And why is that? Well, think about it. An economy this strong doesn't really need the help of lower interest rates. And worse, all that strength could be the very thing that kicks inflation back into high gear. So naturally, the bond market saw this and reacted instantly. The second traders figured that rate cuts were probably off the table for a while, they started selling bonds. And what happens when they do that? Yields go up. The 10-year Treasury, which is a big deal because it influences everything from your mortgage to your car loan, shot up to 4.19%. And this is the crucial point that expert Megan Horniman is making here. The entire conversation might be about to do a complete 180. You know, we went from asking, okay, when is the Fed going to cut rates, to now having to seriously ask, wait, could they actually be forced to hike them again? That's a huge shift. So this whole new reality, this higher for longer interest rate world, it's really starting to split the market in two. It's creating a very clear divide between the winners and the losers. And you can see this play out just perfectly when you look at how different sectors performed. The materials sector, for example, absolutely soared, up 3%, thanks to that commodity boom we talked about. But on the flip side, small cap stocks, the ones that are super sensitive to borrowing costs, they actually went down. Why? Because all those hopes for an early rate cut just, poof, vanished.
But it's interesting, right? While those rate-sensitive stocks were having a tough time, companies built on pure innovation were the clear winners of the day. Investors were basically saying, hey, if you have a powerful growth story that doesn't depend on the Fed, we're in. Look at Novo Nordisk. It just surged over 7% after a huge drug approval. And even the giants like Nvidia and Google, they rallied on their own good news, totally separate from what the Fed might do next.
And this higher for longer idea didn't just stop at stocks. It rippled right through the currency and crypto markets too. The US dollar got stronger, which makes sense. But at the same time, money started flowing out of the riskier, more speculative stuff. And that's what sent Bitcoin and Ethereum sliding. Okay, so you've got this super complex, almost contradictory situation. So how on earth is an investor supposed to navigate it? Well, if you look at how the market is behaving, it seems like two very different paths are opening up. So at the end of the day, you've really got two different playbooks. On one hand, you have the aggressive play. This is the lean into the boom strategy. You're betting that the momentum in hot areas like AI and software is just going to keep going. Then there's the other path, the defensive one. This strategy basically says, all this booming is going to lead to inflation. So you protect yourself by owning real physical things, like gold and copper, stuff that tends to hold its value when the dollar buys less. But here's where it gets really weird. Despite all this tension, all this push and pull, there's just no fear in the market. The VIX index, which is basically Wall Street's fear gauge, is chilling out near historic lows. It's like the market is just shrugging its shoulders. For now, at least, it seems like everyone is surprisingly calm. And that really brings us to what might be the perfect metaphor for what's happening right now. It's like the market is this high-performance sports car, and its engine is running beautifully. Maybe. A little too beautifully. The real concern isn't that it's going to crash, but that the engine itself is just going to overheat from all that power. So let's wrap this all up. What we have here is this disinflationary boom. The economy is so incredibly strong that any talk of a recession is basically off the table. But that very strength is what's putting the Fed in a tight spot, making those rate cuts we were all hoping for look pretty unlikely. And what's the result? The market is trying to do two things at the exact same time: celebrate this incredible boom while also trying to protect itself from the inflation that might come as a result. And that leaves us with a really big question to think about, doesn't it? In an economy that's this strong, with an engine running this hot, is it possible that the biggest risk we face is the boom itself? It's definitely something to keep in mind as we watch this powerful, but yeah, potentially overheating market engine.